Welcome back to the Crypto Club podcast. This is Gons, and as always, we have Mr. Hobo here.
Yep. Good afternoon.
Welcome back. This is episode 12.
That it is.
We got quite a few things to talk about.
Quite the interesting week indeed. Just starting off this episode, looking at the Bitcoin chart here as per usual. Bouncing a little bit over the past 3 days. Nothing too crazy. We're just kind of crabbing in this little range that we've been in since early June. And yeah, it's interesting. We've had quite a few sort of catastrophic catalysts happen over this last month, and we really haven't moved too far down. Just kind of crabbing along here. I've seen Celsius go bankrupt and several other huge funds being liquidated.
It's interesting because, like you mentioned, we've had a lot of bearish news, especially within the last week or so, right? The inflation hit 9.1% as measured by the U.S. government last week, or this week, I'm sorry.
Yeah.
And the market, initially dove down on the news, but it rallied right back up, which is very odd.
Right.
And crypto did the same thing. The stock market did the same thing. I'm looking at the S&P 500 chart now, and it's actually not like it rallied upwards, which is really interesting to say the least.
For sure.
And so I don't know if we had just at a previous point, I would say back in June, if we had just priced in like absolute fear, which it certainly felt like it back then.
Right.
However, I will say that the state of like the macroeconomics that we're facing up ahead of us, there is still room for potential downside, because we still haven't hit a recession in the U.S. We still have Ukraine and Russia going on, and there's overall just global inflation, there's a ton of other things that could send us downward as well. So it's not to say we're out of the woodworks, but it is interesting to see that the markets overall are, generally speaking, just going sideways with a slight trend upwards, compared to the June 16th, 17th bottom. And it's just really bizarre. I was even watching like some real estate videos that I normally just keep tabs on.
Yeah.
And they were talking about how consumer spending is actually up this month, believe it or not. So in May, we went down like 0.3%, which is bad, but it's not terrible. And in June, we actually saw consumer spending go up 1%, which when that came out, people were like, what? So it's really bizarre. And a lot of small businesses too are reporting that Q3 is doing a lot better than Q1 and Q2 was for them. So it's weird. It's a really weird situation going on.
For sure.
I would be inclined to say too that if things continue in a general sideways fashion and we don't have any downward, macro pressure like World War III, global depression, recession, kind of situation, we may have hit the bottom or damn near close to it. So time will tell, and obviously, be patient, because there's a lot of things that can trigger a downside. We certainly aren't out of the woodworks, but really interesting stuff in the markets. Really crazy.
Right. We're certainly closer to the bottom than we are the top. So
that is true.
Yeah, it's one way to look at it. Just speaking quite literally, And also, while consumer spending may be up this month, I know that consumer credit is way up as well. So
yes, that's another thing too. Wells Fargo said that credit is going very well in Q3. But also, I mean, it's a good thing and a bad thing, because what you have to consider is we have a lot of spending, but if it's all borrowed spending, then it's just deficit. And it's not necessarily good to be over leveraged, especially in this kind of market with these kind of interest rates. It can really cause some liquidations and bankruptcies, and then kind of send us back into like a debt default crisis, similar to like the housing market crash of '08.
For sure.
But you're right, it's a double-edged sword, because they did report that, credit usage is up, and people haven't stopped spending, which is a good thing, but also there's kind of like some mediation involved there, that you're not, borrowing $10,000 from the bank and spending 9,900 of it.
Right.
Right.
But yeah. So that covers the market. We're gonna start this week's Crypto Club off with a little anecdote of something new that has launched this week. We are neither endorsing nor saying anything negative about the token. It's just an interesting concept, so we figured we would throw it in.
It's a spotlight, basically. So this token came out yesterday. I mean, it officially launched yesterday on Uniswap, called Golden Goose. And even though and again, not to FUD it, not to praise it, not to market it, just it's interesting, right? There's, their use case or their utility, I would imagine. I haven't done my due diligence, to be quite frank, but they have gone throughout the city of Boston. The project is called Golden Goose Boston. And they've gone throughout the city of Boston to several different areas, and they have placed golden placards throughout the city in hidden spots, and they've created a Discord community where you have clues for all these different locations where they place the placards. And at every placard, if you're the first person to find it anyway, you will find a piece of paper with a seed phrase on it. And when you go to, redeem that seed phrase and claim the wallet, you're going to find 10 million tokens, I believe, for Goose, which is their token, Golden Goose. And those tokens, as of yesterday, were worth anywhere between $1,000 and $2,000. I think it's actually gone up now, but super interesting. And they set aside a large portion of their token supply to do this. So they actually said so far they've put out 30. 26 of them have been found. So there's 4 left currently, and they're supposedly going to add more this weekend. But it's just such a unique use case. It reminds me of like Pokemon Go, but for degens,
Right.
like crypto degens. So you're gonna see a lot of like degen guys walking around downtown Boston. Some fedoras, some neck beards, who knows? But
Right.
really, really interesting. I mean, and again, it's not to praise the token, it's not to FUD it either. I just, as an individual and as a crypto person, I love to see new utilities and creativity in the space, because this is the kind of thing that not only helps the whole industry grow, but it also gets people thinking, right? Because as a person that may see this project, you may just be like, oh, I'm gonna drive to Boston today and go look for these. Cool.
Mm-hmm.
But there may be somebody that sees this and they're like, whoa, this is genius. And then maybe I do it in Phoenix, right? Or somebody may see it and go, hey, you know what, this is smart, but what if you did it this way? And so you get people thinking, and the creativity starts to spread, and then you start having newer utilities or use cases or ideas coming out that benefit the space. So I just want to praise them for being creative and doing this. It was really cool.
For sure. Definitely something new. You know, it's not too often you see something completely new in the DeFi space.
And these are generally the projects that do really well, especially in the kind of market we're in now, are these innovative projects that do something different, right? Whether it's different tokenomics, different functions for the contract, right? um that that is kind of what does really well regardless of market condition. So just like how SafeMoon, I know they didn't really introduce Reflections, but just like how they founded Reflections and made it their thing, they got rewarded heavily for that, last cycle. So really cool stuff. I think we have some screenshots. I don't know if you put them up already, Hobo, so they could see them.
Yeah, I've been looking in the Discord.
Yeah, super
All the
cool.
pictures.
And so then I guess people report when they find them and they post pictures of where they were. Um, just really cool stuff. It's and again, like it's crazy, right? Because I think, see if you can find the info, Hobo, but I think they're doing like 300 total um clues. So
Yep.
they're essentially giving away 600K worth of tokens as long as the price stays consistent, with where it's at now. That's
Right.
crazy.
You know, at the same time, though, I just want to point out, like, something like this is totally riggable. You know, like, he could just tell all his friends where the clues are.
Yeah, I thought about that too, or I thought about like, right now there's 24 of them that have been released. Like I would just go to Boston and then just be on the lookout for people like placing stuff in weird places and just follow him around all day.
Yeah, Boston's a big place. Good luck with that.
It's Well, it's huge too, right? Because I was looking at all the different areas and it's massive. Like if you want to do a scavenger hunt, he picked a good city to do it in.
Mm-hmm.
Um, I even had I have some friends in Boston and I texted them like, "Yo, are you available?" This was at like 11 o'clock at night. I'm like, "You gotta
Nice.
go look for these," but they weren't interested.
Free money, no thanks.
Yeah, I mean, again, each wallet is like almost 2K right now. That's
Right.
crazy. So, kudos to them. Kudos if you found any. Um, and yeah, I mean, it'd be cool to see more of these pop up throughout the country. Honestly, like it makes sense too, somewhat from a business perspective. I guess it's
Mm,
definitely gonna be like I could see this being reported by like the local news station in Boston and picking up traction.
yeah,
Um, and obviously, in turn, that's going to get people to invest in the token for a certain amount of time. But obviously, it's not a sustainable business model. It just operates off hype and media attention and marketing. But it's still really creative nonetheless.
for sure. But yeah, so get on to our first story here. Just kind of a market debrief of the week. So Bitcoin and Ethereum gain momentum. Market turns green. Bitcoin price settled above the 20,000 USD pivot level. Bitcoin gained pace for a move above the USD 20,500 resistance zone. It is currently up 5.7% and might rise further above the 21,200 resistance. Similarly, most major altcoins are gaining bullish momentum. ETH rallied 13% and cleared the $1,200 level. XRP is aiming for a move above the 35-cent resistance zone, and ADA could aim for a rally if there's a move above the 45-cent resistance zone. Something interesting I saw today was, I want to say it was yesterday, XRP had a volume spike of like 5% outside the standard deviation, which was massive for XRP, and if XRP ends up clearing the lawsuit, that could certainly be a good catalyst for the crypto market as a whole to kind of help us choose a direction here. So after a close above the $20,000 pivot level, Bitcoin price started its increase. Bitcoin was able to clear the 20,500 resistance zone and opened the doors for a move above 20,800, which we are currently lying above. So yeah, many altcoins are currently moving higher, including DOT, TRX, SHIB, Matic, AVAX, Uni, LTC, FTT, Near, Atom, XMR, Algo, and XTZ. Matic rallied nearly 13% and surged towards the 70-cent level. I believe one of the big catalysts for Matic was not only the momentum of the entire crypto market over the last few days, but they did score a partnership with Reddit, I believe, which we will be talking about later in this podcast. But really Bitcoin is kind of the grandmaster of the whole crypto market. So anytime you have Bitcoin making some upwards moves, as we've seen from this push of 19,000 up to just bouncing off 21,000 as we're speaking, you're going to see these different altcoins gaining and losing higher percentages, but coinciding with the moves. So that is mostly the state of the crypto market this week. Kind of just bouncing around here. The total crypto market cap still under 1 trillion, but just barely. We bounced from 830 billion on the 13th, sitting at 914 billion. I want to say the total market cap was maybe 2 or 3 trillion at the peak.
I think it was like you're right, about 2 to 3 trillion. And we were sitting like slightly above 1 trillion back in like the March, April, May area, I believe. But what are we at now?
914 billion.
Yeah. It'd be nice to see the markets reclaim that back up to 1 trillion.
Right. That in itself is kind of a psychological resistance for the market as a whole. It's that $1 trillion level. But, yep. So that kind of just sums up where we are at. So let's get on to our first real story here. So embattled crypto lender Celsius files for bankruptcy protection. Crypto company Celsius has filed for Chapter 11 bankruptcy protection after a month of turmoil. And there's tons of speculation leading up to this that Celsius would be declaring bankruptcy. In this, I want to say they declared bankruptcy 2 or 3 days ago. So
yeah, it was very recent.
Yeah. In a Wednesday statement, Celsius said it would look to stabilize its business by restructuring in a way that maximizes value for all stakeholders. Celsius said it has $167 million in cash on hand to support operations in the meantime. Earlier, CNBC reported the company's lawyers were notifying individual U.S. state regulators of Wednesday evening, according to a source who asked not to be named because the proceedings were private. This is the right decision for our community and company, Alex Mashinsky, co-founder and CEO of Celsius, said in a statement. I am confident that when we look back at the history of Celsius, we will see this as a defining moment where acting with resolve and confidence served the community and strengthened the future of the company. The Hoboken, New Jersey-based company made headlines a month ago after freezing customer accounts, blaming extreme market conditions. Wednesday's news marks the latest high-profile crypto bankruptcy as prices plummet. And then we talk about this later on in the podcast, but Voyager filed for Chapter 11 bankruptcy protection last week after suffering losses due to exposure now defunct hedge fund Three Arrows Capital. A judge in New York bankruptcy court froze Three Arrows Capital's remaining assets this week. The fund is now in the process of liquidation proceedings. Unfortunately, this was expected. It was anticipated. It does not, however, stop our investigations. We will continue investigating the company and working to protect its clients, even though it's insolvency. Joseph Rotunda, Director of Enforcement at the Texas State Securities Board, said of the Celsius bankruptcy filing. Celsius did not immediately respond to CNBC's request for comment. The company has more than 100,000 creditors, which could include both customers and lending counterparties, according to the bankruptcy document. Its largest unsecured claim is an $81 million from the Cayman Island-based Pharaoh's Fund. The filing also lists billionaire FTX CEO Sam Bankman-Fried's trading firm, Alameda Research, as a creditor with $12 million unsecured loan. Celsius was one of the largest players in the crypto lending space, with more than $8 billion in loans to clients and almost $12 billion in assets under management as of May. Celsius said it had 1.7 million customers as of June and was competing with its interest-bearing accounts and yields as high as 17%. The firm would lend customers crypto out to counterparties willing to pay a sky-high interest rates to borrow it. Celsius would then split some of that revenue with users, but the structure came crashing down amid a liquidity crunch in the industry. I'm surprised that they're not under investigation for operating as a security with this kind of a revenue sharing structure. But
so do you know how all these lending companies were operating basically?
Well, I mean, it's essentially you lend them your money and then they trade with it, as far as I'm concerned.
So it goes a little deeper than that. Did you ever do any of like I think it was AVAX? When AVAX first came out and it was super popular, there were a lot of guys shilling the borrowing and the staking protocols. I forget what the name was on the Avalanche. Do you remember the most popular one on Avalanche?
No,
by chance?
I've never really gotten into staking or things like that, to be honest.
Okay, so it was basically a staking farming. Nonetheless, so the way it works, right, at least on these, is you had a platform where you could deposit 10 grand and you would earn rewards on that 10 grand,
right,
which you're staking and farming. But the platform would then say, okay, hey, you staked 10 grand with us. We're going to let you borrow against that as well, so that you have some funds to work with. So out of the 10 grand, we'll let you borrow 8 grand. So what these farmers would do is they would then take the 8 grand that they borrowed against their 10 grand and they would deposit it back into the platform.
Nice.
So now they have 18 grand deposited. But then the platform says, hey, so now that you've deposited 8 grand, we're willing to lend you 6 grand. And so you see it becomes a cycle, right?
Right.
And so you can borrow against yourself over and over and over again until you dwindle down. And so your 10K becomes over leveraged to the point where you're essentially staking and farming with like 50 grand.
Mm-hmm.
And so this is basically like how the degen DeFi farming and staking went down back in that time period. But it turns out that this is exactly what all these, high valued lending companies were doing, right? Celsius, Three Arrows Capital, etc. What they were doing is they were taking your funds and they were doing this. They were staking it within each other, right? So this is why it says here that part of the reason that one of these went bankrupt is because they had some funds on Three Arrows Capital.
Yeah.
So it hurt them. So it becomes a domino effect, not because they're in the same industry or because they're similar, but it's because they were all borrowing and doing this within the space with each other. So if Three Arrows Capital is offering 10% and Celsius is offering 20%, Three Arrows Capital is taking your money and putting it on Celsius,
mm-hmm.
and they're keeping the 10% and giving you the 10%.
For sure.
Celsius is doing the same thing, just with somebody who's doing it at 25%, and so they're keeping the 5%, and so it becomes this
yes,
whole over leveraged.
Yes and no.
situation.
Like these really big funds, I know that they like there's some arbitrage that they do. There's quite a few different. Um,
There are some, yeah, like it's not all just lending and leveraging, but a vast majority of it was,
right.
and that is what led to, all these bankruptcies and crashes because it becomes a domino effect.
That it does. That it does. Um, the market crashing was just the first domino, and all these companies are taking each other down. And it's just it's like a negative echo chamber. Um, but that kind of leads us on to the next story of Voyager Digital filing for bankruptcy. So they are also a crypto lender. They are mostly known for being an exchange. So the U.S. crypto lender Voyager Digital said on Wednesday it had filed for bankruptcy, becoming another casualty of a dramatic fall in prices that has shaken the cryptocurrency sector. Crypto lenders such as Voyager boomed in the COVID-19 pandemic, drawing deposits with high interest rates and easy access to loans, rarely offered by traditional banks. However, the recent slump in crypto markets, sparked by the downfall of two major tokens in May, has hurt lenders. That would be Luna and UST, or it might be Bitcoin and Ethereum. They could be alluding to both. So, New Jersey-based Celsius in June froze withdrawals and has hired advisors on a possible bankruptcy filing. Voyager froze withdrawals this month, as did another lender, Singapore's Vald. Last week, Voyager said it had issued a notice of default to Singapore-based crypto hedge fund Three Arrows Capital for failing to make payments on a crypto loan totaling over $650 million. 3AC later that week filed for Chapter 15 bankruptcy, which allows foreign debtors to shield U.S. assets, becoming one of the highest profile investors hit by plummeting crypto prices. 3AC is now being liquidated, Reuters reported last week. The prolonged volatility and contagion in the crypto markets over the past few months and the default of 3AC on a loan from the company's subsidiary, Voyager Digital LLC, requires us to take deliberate and decisive action now, Voyager Chief Executive Officer Stefan Erlich said in a statement. In its Chapter 11 bankruptcy filing on Tuesday, Voyager, based in New Jersey but listed in Toronto, estimated that it had more than 100,000 creditors and somewhere between $1 billion and $10 billion in assets and liabilities worth the same value. Voyager had last month signed an agreement with trading firm Alameda Ventures, founded by Sam Bankman-Fried, CEO of FTX, for a revolving line of credit. A filing with the U.S. Bankruptcy Court, Southern District of New York, showed that Alameda was Voyager's largest single creditor, with unsecured loans of $75 million. Alameda did not immediately respond to a request for comment. Chapter 11 bankruptcy procedures put a hold on all civil litigation matters and allow companies to prepare turnaround plans while remaining operational. In a message to customers on Twitter, Elrich said the process would protect assets and maximize value for all stakeholders, especially customers. Voyager said on Wednesday it had more than $110 million of cash and owned crypto assets on hand. It intends to pay employees in the usual manner and continue their primary benefits and certain customer programs without disruption. Voyager has hired Moelis & Company and the Concello Group as financial advisors, Kirkland & Ellis LLP as legal advisors, and Berkeley Research Group LLC as restructuring advisor. So, another huge domino falling. A $650 million loan from 3AC surely is a huge loan. Considering that.
So,
go on.
what I was going to say is, what are your thoughts about Mr. Sam Bankman-Fried essentially almost bailing out all these companies?
I don't know. I mean, I think he's trying to do what he can. Also, there's been a lot of rumors and somewhat misinformation circling around about what exactly he's reviving and what he isn't. Yeah, I don't know. I think, he's one of the richest people in cryptocurrency. I think he's trying to do what he can to play his part in the success of the crypto market and stability in this time of uncertainty.
Yeah, so I would agree. What I found really interesting that I kind of saw, I want to say a week or two ago, is somebody compared Sam Bankman-Fried bailing out all these, lending companies in the crypto space to JP Morgan, right, from Chase.
Mm-hmm.
Because back in the 90s, there were a lot of, there was a similar situation with the banking industry. And what was happening is a lot of the banks were over leveraged. There wasn't nearly the, laws, regulations, and criteria in place for banks to have, more stability, right? So kind of the bank system back then is similar to how the crypto system is now, right? It was very early on in its lifespan, and they hadn't figured out a lot of ways to keep it, regulated and stable.
Right.
So anyways, back then there was a situation with the banking system where people didn't trust the banks. They were finding out that the banks were over leveraged, and they were going out in droves to the streets, to the banks, to withdraw their funds. And you even see pictures from back then. The streets are filled with people just waiting to withdraw their funds from the banks, and the banks don't have it.
Mm-hmm.
And so what JP Morgan realized, well, at least this is what they claim, right? Is, he is arguably one of the richest people in the country at this, point in time. And he's watching his industry collapse, even though his bank may not necessarily be involved, but he's watching the banking system collapse, and his competitors are, being liquidated and collapsing.
Yeah.
But what ultimately happens is you now have people that don't trust the banks, don't want to use the banks, and what he ended up doing is bailing all these banks out, but also putting aggressive stipulations on these loans, right? So if you can't pay it back, or if you default and go bankrupt, the company is now JP Morgan's. So it was a genius move by him, because essentially it set up his company to be what it is today, one of the largest banks in the world, JP Morgan and Company.
For sure.
But either way, he either acquired those companies for pennies once they went bankrupt if they failed to pay it back, or he saved them and he saved the banking industry, which he was a part of. So a lot of people are making the same comparison to Sam Bankman-Fried, in the sense that Sam Bankman-Fried is one of the richest people in the world right now. Crypto is in the same situation as the banks back in the day, where, again, we have a lot of uncertainty. It's still fresh, and there's not, regulations and stuff in place to keep people from mass withdrawing, from over leveraging, etc.
Right.
And we're now watching Sam Bankman-Fried's competitors and, just overall people in the space that are massive players collapse. And so it's in Sam Bankman-Fried's best interest, to bail these companies out and protect the industry as a whole. And at the same time, from a more selfish perspective, he may be able to just buy out these, these intellectual properties and these companies for dirt cheap when they do bankrupt, if they fail to survive.
Mm-hmm.
So it's like a win-win for him on all grounds.
Yeah. I mean, I don't know. Something I would note is, as far as what I understand, he's not necessarily bailing them out. Like, yeah, he's offered them a line of credit, but it's only 75 million, which is surely not an amount to scoff at. But I mean, it says right here, somewhere between 1 billion and 10 billion in assets and liabilities worth the same value. So I mean,
Well, yeah, he's not bailing them out per se. But I mean, at the same time, like these companies are drowning, and he's throwing them some kind of life jacket in a way,
right?
uh, to hopefully keep themselves afloat and possibly survive. So it's essentially that is what he's doing.
Yeah.
Um, just not to the full effect of like, hey, I'll pay off all your loans, and who knows, he may go that route, right?
Mm-hmm.
Um, as I said before earlier in the podcast, we still haven't seen, there's still the possibility for more downside and more blood. So he may be waiting for that. Um, who knows? But it's just a really interesting comparison nonetheless that does really line up. Maybe not 1-to-1, but pretty close.
For sure. Yeah, that is a quite an interesting anecdote. We all know how big the banking industry is now.
Yeah, for sure. And imagine the people, back in the 90s, or not 90s, whenever it was, like 1940, 1950, who lived through that bank panic, right? If you would have told them to invest in a banking company's stock price back then, they would have been like, you're crazy.
Mm-hmm.
But, now it proves to be a massive, potential move that they could have done. So, same situation right now with crypto. We find ourselves still so early in this technology, in this industry. And I think there will be a lot of parallels moving forward, because essentially crypto is just digital banking, just electronically on the blockchain, which is the next evolution of what the traditional banking system is.
Right. Something else interesting, kind of unrelated, but Sam Bankman-Fried got his start in crypto. He became a billionaire very young, and it was only by arbitraging Bitcoin at
Mm-hmm.
an
Yep.
exchange. Quite crazy. I mean, that's not hard. You just buy a lot of Bitcoin on one exchange, sell it on the other, and he became a billionaire. But yeah, so we'll move on to the next story here, talking about hackers stealing $670 million from DeFi projects in quarter two, up 50% from quarter two the year prior. So hackers and fraudsters stole a total of $670 million from various crypto protocols during the second quarter of the year, according to a report by major bug bounty and security services platform ImmuneFi. In 50 instances of both successful and semi-successful hacking attempts, DeFi projects lost $670 million during the last quarter, said the report shared with CryptoNews.com. The figure is up almost 50% to the same quarter in 2021, when hackers and fraudsters stole $440 million. I think it's important to note that all hacks are not the same. I mean, let's see, I don't know what quarter it was, maybe quarter 3 of 2021, quarter 4, something like that, when the Axie Infinity bridge hack happened. I mean, that was like $670 million in one hack.
Yeah.
But so the report claimed that the bulk majority of the losses, almost 97%, happened as a result of hacks. It added that black hat hackers are now primarily targeting and exploiting DeFi projects, as 49 out of 50 instances involved DeFi protocols. So Beanstalk, a decentralized credit-based stablecoin protocol, ranks first among the top losses, with around $182 million lost due to an exploit. That makes me think that it must have been a flash loan or something, considering that it was a stablecoin.
Could have been, yeah.
So the next top hacks include the Harmony Horizon Bridge, which was $100 million, I want to say. Mirror Protocol and Fey Protocol accounts, which lost, $100 million, $90 million, and $80 million, respectively. This information comes as a report by crypto research firm Chain Analysis found that crypto assets stolen from DeFi protocols rose by a staggering 1,300% in 2021, reaching $2.3 billion. The report said that DeFi hacks continue to account for a larger share of all crypto hacks. For instance, 31% of the total amount of crypto stolen in 2020 came from DeFi projects, while in 2021, 71% of all crypto stolen was drained from DeFi protocols. I think that's sort of a given, as that's where all the money is. You can either go after 1,000 individuals and walk away with $10 million, or you can go after one protocol and walk away with $100 million. So Glassnode also noted that hackers have recently shifted their focus from crypto exchanges and centralized crypto platforms towards DeFi projects, mainly because they are open source, meaning their code is publicly visible. Being open source is an important aspect of DeFi because it enables everyone to verify the code. However, it also allows bad actors to search for loopholes and exploit breaches. Kate Kurbanova, co-founder and COO of the risk management platform Apostro, explained that DeFi's growing popularity is attracting a new crop of developers into the space, which has therefore seen a massive proliferation of protocols with similar business models and code bases, with all brandishing a very common trend of shabbily conducting audits and other security measures that can make their platforms well guarded against attacks. In a comment for CryptoNews.com, Kurbanova argued that the continued rise in hacking, as pointed out by Immunify as a no-brainer, hackers do not get smarter, they only take advantage of the loopholes that exist in protocols that refuse to do their due diligence at the point of launch and subsequently. So hackers will not leave the space, considering how easy they get a payday, she said. And even though there's no one-size-fits-all solution, it is ultimately the responsibility of all DeFi innovators to come up with a solid risk management system that can help safeguard investors and users across the board, said Kurbanova. And added, the imposition of a cap on liquidity might be a very good approach, and if channeled appropriately. While Aave's V3 is built to pioneer this new model, a mix of inbound protocol transaction monitoring can be a feather in the cap in discovering potential threats to DeFi and Web3 protocols, respectively. And essentially what that translates to is, kind of just capping the total amount of funds that can be stored in one place and exposed in a protocol under one pillar, I suppose.
Yeah, pillar is a good way to describe it. Yeah, I don't know. It's just one of those things that is an unfortunate reality to the DeFi space. Being that it is open source, it's a very easy target.
Mm-hmm.
But at the same time, too, it's also a lack of quality developers and security measures in place. Again, the bar in crypto is so low that, nothing's really thought through with, much thought as far as like longevity and safety.
Right.
So that's kind of like a byproduct of what we face because of that mentality, is just a lot of hacks and exploits and poor coding and security measures.
Yep. With every hack comes a learning opportunity. Unfortunately, people tend not to learn from others' mistakes.
And you know what? I love that you use the word opportunity there, because it's not an experience if you don't take it seriously or you don't actually learn from it. And unfortunately, like this article points out, even though it is subjective depending on the size of the hack and, whether it's a massive protocol that has, multi-millions, but either way, hacks are up. And it's because people don't learn from others' mistakes and experiences.
Right.
So they are learning opportunities, but fortunately, a lot of people don't take it seriously or take it to heart when building on Web3.
100%. And there's really nothing you can do about that except let the market do its thing. Exchanges are usually pretty good about blacklisting addresses that are participants in these big hacks, but it still does not nullify the huge loss of funds.
No, absolutely not. So eventually there will have to be some kind of regulation or stipulation in place that will probably have to hold developers partially responsible, because at the end of the day, it's no different than in the real world, right? With architects and engineers, when you draft a building plan or you are, designing a bridge and that bridge fails or collapses, you are essentially responsible for that.
Yeah.
So it has to be a very similar, stipulation or regulation in the crypto space whenever we do get around to, adopting some regulation, that they're gonna have to make these developers responsible to some extent, right? Because in the same analogy of, the real world bridge, that is a failure due to neglect, but at the same time, it's not a failure in the sense that you have some malicious people coming in to destroy the bridge purposefully, right? So there is that aspect to consider. Hackers are purposely on the lookout, destroy,
Right.
protocols and extract wealth from them. Whereas in the real world, that's not necessarily the case.
Yeah, you don't have people trying to blow up your bridge.
We do, but not like for their own gain kind of
Yeah,
situation,
yeah.
right? You have terrorists and stuff like that, but you get the idea though. Essentially, is people aren't purposely doing it either, so there has to be like some kind of middle ground to that, I feel. But I don't know how else would you like regulate that, because at the same time too, like, how do you prove that that developer really did the best he could as far as safeguarding that protocol?
For sure. I think you have liquidity restrictions on how much you can hold, and there's different tiers to that, based on levels of auditing that's been done, levels of security that's been verified. And so kind of like a tiered system into how much responsibility you can essentially take on that coincides with how much protection you've created.
Yeah. So it's a good idea. We'll just have to see how they implement something like that. The other thing too, of course, which I've been saying for a while now, is we should have like some kind of insurance for these massive, massive protocols.
Yeah.
And actually, to kind of backtrack for a second, these massive protocols should be required to have insurance, right? If you are dealing with millions of dollars of crypto, or billions, right?
Right.
You should have some insurance in place by law to protect users' funds.
For sure.
So it should be mandated that you have to be insured, much like the banks have to be insured, right?
Right, but the thing is with banks, at least as far as I know, they're all federally insured. There's no private
Correct.
bank
Yeah,
insurance
they're
companies.
FDIC insured. So, and again, I don't know if this, leads us to the federal government. And again, this is kind of the route I was thinking. Like, if you have a, platform or a DeFi protocol, a lending protocol that's handling, $100 million, and the company is based out of, let's use Luna for example, they're based out of Taiwan.
Yeah.
You should be insured through the Taiwan federal government, um, because that is where that company resides. That, or we introduce like third party insurance companies in the DeFi world. But either way, something needs to be done to where developers are held partially responsible, and we also have some kind of insurance measures in place for users.
Yep, I would agree with that. Yeah, we'll just have to see how it pans out. This is surely bringing lots of light to the issue.
And that leads us to our next topic. We are introducing CoinScan Insurance Group, CSIG. Feel free to insure your DeFi protocol with.
Okay. Gons is joking.
Clearly.
Very funny, very funny. Our next story, however, is GameStop's NFT Marketplace leapfrogs Coinbase's in less than 48 hours.
This is crazy.
Yep. I'm not surprised. I think GameStop has the perfect market for their own NFT marketplace, much more than Coinbase. I feel like Coinbase is like where your parents and grandparents are going to buy crypto. Coinbase, or not Coinbase, GameStop is, kind of really the whole Reddit and Wall Street Bets thing brought GameStop to light and kind of turned it into what it is today. And a lot of those people are the same group that, are interested in NFTs and whatnot. So when GameStop said that it would launch an NFT marketplace earlier this year, many in the Web3 community were skeptical of the meme stonk retailer's plans. Yet in just 2 days since going live, GameStop's NFT marketplace has seen more sales activity than the much vaunted Coinbase NFT has managed in the 2 months since it launched. The top 50 collections have generated over 3,000 ETH in sales volumes, according to the website. The action is dominated by the MetaBoy collection, which accounts for just under a third of the total volume. Meanwhile, Coinbase NFT has only seen 1,700 ETH of trading volume since its inception, according to data from Dune Analytics. Marketplace leader OpenSea did $17 million in volume on July 13th alone. So on July 14th, OpenSea CEO Devin Finzer announced that the company is scaling back its team by 20%, citing an unprecedented combination of crypto winter and broad macroeconomic instability. The company seems to be preparing for a protracted winter of lackluster demand, as it's unlikely that the move was made for financial reasons. OpenSea has earned nearly $1 billion from trading fees since 2021 and raised $300 million in Series C funding just 6 months ago. Competing NFT marketplace LooksRare was quick to respond to Finzer's tweet with a list of job openings that it's looking to fill. So nearly 480,000 NFTs worth $183 million changed hands in the week ending July 11th. Volume was $20 million higher than the prior week, while the number of transactions rose by 20%. So you see, OpenSea still has more than 90% of the volume hosted on the website. That's just the industry standard. They were the first to really become a big NFT marketplace. And I think as other platforms show their strengths and innovations, that will likely change. But as it stands, OpenSea is kind of just the norm for NFTs. I think it's super cool to see GameStop's NFT marketplace doing better than Coinbase.
I mean, OpenSea is like the current leader in NFTs, as far as marketplace. But I mean, it's no small feat that GameStop in 2 days has done, a quarter of OpenSea's volume, in a month. That is mind blowing.
No, they did a quarter of OpenSea's volume in a day.
Whoa.
Yeah, OpenSea did 17 million on July 13th.
That is insane.
Yeah, I mean, nonetheless, GameStop did more volume than Coinbase did in 2 months, in 2 days.
Exactly. In 2 days. So GameStop is crushing it. And I could see it working later on for them once games become, like their microtransactions become NFTs.
Right.
At that point it would make a lot of sense for GameStop to go that route.
100%. I could totally see GameStop becoming a big crypto player. They've got the perfect audience.
They do. I mean, if you think about it, most crypto people at this stage, right? We're talking about the early adopters here. They are technology driven people, and they're generally the younger crowd.
Right.
So we have a lot of millennials, and basically, I would say a lot of millennials more than anything in the crypto space. So millennials grew up on GameStop.
Totally. Yeah, not only did they grow up on GameStop, but GameStop encapsulated a just the perfect audience with the whole stock situation.
That too, yeah. I mean, it'll be interesting to see. Like, definitely keep your eye on GameStop, because if GameStop can grow with their audience throughout time, as GameStop grows alongside the millennials, I mean, you essentially have a company that's backed by almost an entire generation.
Right.
Uh, that that in itself is massive. So if they can just follow the trends, then they could be around for a long time, and they could be a very powerful player.
Totally. They're going to have to make some changes to how they operate business, just as games are rarely on discs and people less and less need to shop in store for gaming related items, both due to things being digital as well as just online shopping. So, them moving kind of into the metaverse part of the world, I could see being a good move for them.
For sure. And just crypto integrated into games in general. Obviously there isn't a sustainable model yet, but if there does come a time where one does exist, I mean, that would be their place to really dive in and necessarily go all in, because that's where they would find a lot of success.
Right. Yeah, it would have been interesting to see how Axie performed over time if it didn't get hacked.
They had a pretty good run.
Right, and I believe Sand is still going strong as far as the ecosystem.
Yeah, I don't know about I don't keep up with Sand.
Yeah, it's like
They're much metaverse, to be honest.
it's like a Roblox with crypto.
Exactly.
But
No.
we'll move on to this next story here, talking about Polygon scoring a deal with Reddit for the new NFT Marketplace. So if building your project during hard times is the true test of DeFi, then Polygon is off to a good start in this bear market as it solidifies its position as a leading Ethereum scaling solution. On July 7th, Reddit, the popular social networking website, launched an NFT marketplace for online avatars that is powered by the Polygon proof of stake chain, Polygon's Comet chain, and flagship Ethereum scaling solution. I didn't even know Reddit had an NFT marketplace. It looks like it's live.
Is it really?
Yeah, here, let me click this link.
Wow.
Yeah. It says it launched it. Let me see if I can find it real quick. I'm not seeing anything. Who knows? Anyways, so Reddit has created 90 designs for its early access series of NFTs, with the total number of tokens going on sale tipped to a total tens of thousands. The NFTs come with licensing rights, allowing them to be used as avatars on other online platforms and will exhibit a glow-like effect next to comments posted on Reddit. Reddit's NFTs are currently available to members of the subreddit r/collectible avatars and will be made available to all users via its avatar builder page over the following weeks. The non-fungibles will be purchasable via credit or debit card and can be stored in Reddit's proprietary vault, meaning users do not need to have experience with cryptocurrency to use the marketplace. The tokens are purchasable at fixed prices ranging between $9.99 and $99.99. On the same day, the investment app Robinhood launched support for withdrawals and deposits for the ERC20 version of Polygon's native token, Matic. I think that's super interesting that Reddit has its own proprietary wallet, and they totally handle the transactions with Visa, credit and debit. Seems like NFTs without crypto being involved at all.
I mean, anything you can do, right, especially in the early stages that we are in with crypto, to facilitate transactions for, the average user that doesn't know crypto or exchanges or doesn't want to deal with wallets,
the
better. So, yeah, no, this is a smart move by them for sure.
100%. So, Polygon is a leading team working on Layer 2 scaling solutions for Ethereum. Its proof-of-stake chain ranks the 6th largest smart contract network, with a TVL of 1.6 billion, according to DeFi Llama. In August 2021, Polygon announced a strategic pivot and allocated $1 billion towards research and development for zero-knowledge-based scaling solutions. ZK protocols, also known as zero-knowledge protocols, enhance the privacy of transactions by only disclosing the time and date at which they occur on the blockchain, with only counterparties able to access further data relating to a specific transaction. In May, Polygon launched the mainnet beta version of Nightfall, a hybrid ZK and optimistic rollup solution, which battles and settles transactions on a separate chain before rolling them up into a single transaction for validation on the Ethereum mainnet. Developed in partnership with Big Four financial services firm Ernst & Young. So Khan emphasized that existing ZK-based rollup solutions are not EVM compatible, noting that dApps launched on rival ZK-based solution Starknet must be written in coding language Cairo rather than Ethereum's native Solidity. Releasing a ZK rollup that is EVM compatible is a massive turning point for the scalability and adoption of Ethereum secured rollups. dApps will be easily able to deploy their existing applications from Polygon Proof of Stake Chain or Ethereum mainnet onto Polygon Hermes, something like that, Colin said. The Matic token has taken a beating amid the recent bear trend despite Polygon's development activity. Although the token is up 10% over the past 24 hours in response to news of the Reddit marketplace, the token is still down 80% from its late December all-time high of $2.92, according to CoinGecko. The proof of stake chain's TVL is also down more than 84% since peaking above 10.5 billion last June.
Whew.
Yeah, so, I think Polygon working on the first ZK protocol that's EVM compatible is super optimistic for the project. EVM is what the majority of really adopted chains operate on. That's kind of the industry standard as far as the coding being in Solidity. And this could play out huge for Polygon.
It's definitely a good move for them. No doubt.
Yeah. Super cool to see they're teaming up with Reddit for the NFT Marketplace.
Reddit's a big partnership for them for sure. That's huge.
Yeah, it'll be interesting to see how much it catches on.
I mean, this is essentially, right, because over time, especially across cycles are what wipe out the most projects.
Mm-hmm.
It's going to be interesting to see which ones stay in the top 10 and which ones, end up fading and dying out. Moves like this are generally lead me to believe that Matic will probably stick around. Whereas by comparison, you have other top 10 crypto projects by market cap that aren't really doing anything right now, as far as innovating, developing, or pushing forward. So ultimately, this is what you see in bear market cycles, is just, companies that stick around and continue growing and building, or people that just leave and abandon.
Right.
So good for them.
Indeed, indeed. I think that about wraps up everything for this episode of Crypto Club.
Yes. Also, quick mention too, on our Medium, you will find a lot of articles that we cover, just general crypto news as well. So, there's some big stuff that happens throughout the weeks. A lot of times we can't cover all of it in the podcast, but we do generally write articles on, crypto news and events on a daily basis over on our Medium. So check out the Medium, and subscribe there if you can, so you can stay up to date with all the latest news, not just from the podcast.
100%. We are usually pushing out about 5 articles per week. We try to be very detailed, provide sources, all the good stuff. And yeah, we are also getting very close to a massive CoinScan update that I think is going to be taking DeFi by storm. So make sure you're checking out the links in the description to check out our community and really kind of take a look at what's stirring up at CoinScan.
Yes. If you are hearing this now, I would take advantage of it because you will hear about us later.
100%. Excellent, Gods. All right. Well, we'll see you next week.